is a unique way that you can start to transition money from your traditional tax-deferred retirement accounts into accounts that will grow and compound for you and accessible to you, all tax-free in the future. So if you're 45 years old or older and all of your money is locked up in traditional tax-deferred accounts like 401ks and IRAs, and you are fearful that taxes could be on the rise in the future, it's time for you to get creative and start to shift assets into accounts that grow and compound and are accessible, all tax-free. My name is Amanda Ryba. I have been working as a licensed financial coach and consultant for the past 8 years as of the date this video was produced. And it is my goal to illuminate to the world what wealthy people do with their money. And one thing all wealthy people know and understand is that taxes are always on the rise. And it's so important to eliminate them in the future if possible. Let's dive in. It's very common to meet clients in their 40s that have all of their money locked up in traditional tax-deferred retirement accounts like 401ks and IRAs, waiting to pay taxes on the entire pie when they go to take out slices of it in retirement. But with the US national debt at an outrageous $34 trillion in debt and counting as of 2024, and the expiration of TCJA Act scheduled to happen in January of 2026, I highly doubt taxes have a shot at going down in the future. I don't know about you. And not to mention, when we retire, most people lose all of the tax deductions that they had during their working years and end up taking on additional medical expenses that they probably didn't consider, like medical insurance, Medicare, Medicaid, things like that. Okay, so we know the inevitable doom is coming, but how do we start to get money from taxable accounts into tax advantage or tax-free strategies? Well, you have to act now. The only accounts that will grow and be accessible to you in the future, all tax-free, are Roth 401ks, Roth IRAs, and cash value life insurance. Now, many of you may be thinking, well, Amanda, I don't get offered a Roth 401k through work. Don't worry, a lot of people don't. There's also the option of a Roth IRA. However, once you get into your 40s, you need to take saving for retirement very seriously. So you might want to save more than $7,000 a year, which is the current maximum you can contribute into a Roth IRA if you're under the age of 50. If you're over the age of 50, it is $8,000 a year. And with both a Roth 401k and a Roth IRA, you cannot continue to contribute into those plans once you are in retirement when you're no longer working, which is precisely what we need these accounts for. I'm gonna let you in on a little secret with how I do things with my clients. So if I have a client in a similar situation to what we've been discussing here, at this point, what we might do is stop contributing any new money into those traditional tax-deferred retirement accounts, or if they get a really good match, reduce what they're contributing down to the match. And we're going to redirect all of that money that they were putting into those plans into an IUL policy, an Index Universal Life. Now, if you don't know what an IUL is, pause this video and look at the description below. I have a few videos that are linked that will tell you a little bit more about how an IUL works and what it is. But in short, an IUL is a permanent life insurance policy that grows a cash value inside of it. That cash value grows mirroring a stock market index of your choosing, like the S&P 500 or maybe the NASDAQ. So you have the chance to get some really good growth with zero risk because the insurance company takes on all the risk. You get a 0% floor and that account will only grow. Then in the future, while that money is growing and compounding, it grows and compounds all tax deferred and is accessible to you later on, all tax-free if it's taken out in the form of a policy loan. And my favorite part is the fact that you don't have to have earned income to be able to contribute into these plans. So if you're in retirement and you're no longer working, you can still put money into these policies. And you have control over what the maximum is that you can contribute into these accounts per month or per year. That is based on the size of the death benefit of the IUL. The more life insurance you get, the more money you can stuff into the policy per year. The less life insurance you get, the less money you can stuff in. Now here's another really cool step. So as that client starts to get a little bit older and closer to retirement, they might reach a point where they can roll over one of those traditional retirement accounts from a former employer that they're maybe no longer working for. We can take a look at what's called fixed indexed annuities because these accounts are designed to only grow, again, mirroring a stock market index similar to an IUL, but with that 0% floor. So there's no risk of loss, and you can actually somewhat predict what that account value will be as they get closer to retirement. And this product is key. This is the product that we're going to start to shift assets out of. Let's take a look at a real example. Okay, here we're looking at an IUL illustration for that same 45-year-old individual we've been talking about the entire video that was max funding his 401k, realized he needed to start to get some money into things that will grow and accumulate and be accessible all tax-free in retirement. So he's going to redirect that money that he was contributing into his 401k into his IUL, pay the taxes on it now, and then take the after-tax dollars and put that into his IUL. So if you look up here in the top right-hand corner, let's say that he's putting in $1,500 a month of after-tax dollars going into his IUL. That would be $18,000 a year going in. Now, our goal is to max fund the policy as quickly as we can so the cash grows quick for him because we're working on a shorter timeline. So the minimum death benefit, the minimum life insurance amount that would be required for him to put in $1,500 a month would be $287,000. Now, real clients, I always clean this up. I'd probably round this up to $300,000 just to make it look a little cleaner. But just for sake of example purposes, that's the actual minimum death benefit that he would need to get for this to work. So if we zoom into the actual illustration, you will see, if we zoom in a little bit, there we go. You will see that the year is how many years the account's been opened. Age is how old he is and counting. Assumed premium outlay, that is what he's contributing every year. So $18,000 a year is $1,500 a month. And again, this is max funded, so he can't contribute anymore. That's the max. You could leave wiggle room if he wanted to contribute more in future years. For this example, we just aren't. The accumulated value is going to be the money that he contributed minus the cost to own that $287,000 life insurance policy, plus any interest that he earned. The surrender value is how much of his accumulated value he has access to. So what we're noticing is year one, there's $15,000 in there. He can access $8,000 of it. Year two, there's $31,000 in there. He can access $24,000 of it. This policy that we're looking at here has a 15-year surrender period. So after 15 years, he has full access to all of the money in the accumulated value. But again, this is for future use. So not really concerned with the surrender schedule with this policy because we're not going to touch it for quite some time anyways. And then the death benefit is going to be the actual life insurance amount that is going to grow and accumulate with the net accumulated value added to it. So it's going to be that $287,000 plus this $15,000 number. That's going to equal that death benefit and why that is growing and compounding over time. So you're actually going to see two sections here on the right-hand side. The section on the left is going to show if the account was only earning a fixed rate of return of 3.5% interest per year. The section on the right, which is the one that we will focus on, is going to show this client earning an average of 6.11% interest every single year, where to be honest, most of these accounts average realistically probably somewhere between 9 to 10% over a 30-year span. So this should be very conservative in terms of growth. It's just giving you an idea on how this works. So we're going to focus on these categories on the right. Now, if we take a look back over here, let's say that this client contributes this money until age 60, right? Age 60 is when he wants to retire. He wants to be done working. So if we take a look over, let's see what we're doing with that indexed annuity that we were talking about earlier. Here's a look at an illustration of the indexed annuity that we were talking about. Let's say that this gentleman reached 50 years old and he was no longer working at that same company he had that original 401k through. He is now eligible to actually roll that money over into an indexed annuity, which is going to give him that 0% floor, and the money will only grow just like an IUL. And let's just say that we're working with $1 million that was inside of his 401k at that time. If we turn that into an indexed annuity and we just let that grow, let's say that we just let that grow for 10 years until age 60. By age 60, he's estimated to have an actual account value. If we look all the way over here, I know it's a lot of numbers. He's estimated to have an actual account value of about $2 million sitting inside that portfolio for him to use. Now, the usual rule of thumb with retirement planning is you only take out 4% of the account per year to live off of, right? If you're trying to stretch that account for as long as you live. But here's where it's going to get good. Here's where we're going to be strategic with how we take money out with the intent to shift assets from a taxable asset into one that grows tax-free, right? Accessible tax-free. So instead of just taking out 4% per year, we're actually going to take out 10. Yeah, 10. I know it sounds crazy. We're going to take out 10% of this $2 million every single year. But here's what gets good, right? We're still going to grow. We're still going to earn interest. If you look over here to the right-hand side, we're still going to earn interest, but we're going to take out 10% per year with the intent to start to shift some assets, because taxes will most likely be lower 15 years from now than they will be 30 years from now. So let's start to get money out of these accounts that are taxable and also variable, where this person sustains a lot of risk in the market, and into things that will grow a little bit more conservative for him. So So if we look back over here to the right-hand side, we're going to look at, let's see if we zoom out a little bit, we're going to look at the withdrawals. So let's just say that this client for 15 years, starting at age 60, 61, right? He's going to start taking out $200,000 every single year after taxes, right? Or I'm sorry, $200,000 every single year before taxes, right? Because this money has to get taxed. Now you can assume after taxes that will probably leave him with somewhere around maybe 140 grand. It's really up to debate depending on where taxes will be. So if he's taking out that $200,000 of pre-tax money out of his index annuity every year for 15 years, this is where it gets good. He's going to have an ending account balance of approximately $400,000 by age 75, because again, we're still earning interest, right? You see all these categories over here earning interest. What we're going to be doing during those 15 years, he's going to be taking in probably about 140 grand after taxes. He's probably not going to need all of that to live off of. So what we're going to do is if we go back over to the IUL and we take a look here, we're going to continue to put that $18,000 every single year into his IUL during the years that we're shifting assets. And here you'll see he's continuing to put in that $18,000 a year, which is $1,500 a month, right? To the point where by the time he reaches age 75, he would have contributed $540,000 of after-tax dollars into the account. Now, at this point, he's living off of the money from his indexed annuity during those 15 years, which is taxable, right? There's not anything we can do with it. You can't get money from a taxable account into a tax advantage account without paying taxes. You have to pay the taxes. But hopefully we're paying less on taxes during that time. And then when he hits age 75, now he's got the bulk of his money here inside the IUL, and he can start to take the money out on a loan, which keeps those distributions tax-free for him. So now he's expected to take out $115,000 every single year after taxes from his IUL every single year. Now remember, before we were netting probably about 140 grand, give or take, after taxes from the indexed annuity. Here we're looking at just about 115,000 after taxes from the IUL, but we still have some income coming in from the indexed annuity. So if we go back to the indexed annuity, now let's say he's 76 years old. He no longer wants to take those random distributions out of $200,000 a year. We're actually going to pensionize it at this point. So he's working with a pension value of $403,000. He's going to pensionize it and get approximately somewhere between 4.5% to 5% every single year to live off of an income guaranteed until he dies. And you'll see here, still taking out that guaranteed $24,000 every single year in income until he were to pass away. Let's just say at age 100, right? So now if we look over here, we would have taken out a total of about $3.6 million out of this indexed annuity when he only rolled over $1 million up front. But remember, that entire $3.6 million is taxable. All the while, this individual is still taking out that $115,000 every single year after tax dollars from his IUL, to the point where we would have contributed $540,000 of after-tax dollars into the IUL and taken out a total of $2.889 million tax-free. That's just over a 5x return on your money, where with the index annuity, you're looking at about a 3.5x return on your money. So here, this individual is able to maintain the same lifestyle of living that he was when he was working in retirement, with a good chunk of his money shifting into accounts that grow and are accessible to you all tax-free. Isn't that cool? A little different than what your traditional financial advisor would probably recommend to you, right? Guarantee you haven't heard this strategy before. But what I love about it is both of these accounts, fixed indexed annuities and index universal life, give the client that 0% floor so they can't lose money, and the ability to earn really good interest inside those policies because they're mirroring a stock market index. Now, there's different ways that they can guarantee that 0% floor. Some companies will put a cap in on how much you can earn. Some companies will take a spread, which is a percentage of your profit. Some might just charge you a fee. But either way, when you actually factor the numbers out side by side, they usually end up doing a little bit better in the index strategy just because you don't have to deal with any of the risk. And the closer we get to retirement, the goal isn't necessarily to grow and accumulate a ton of wealth. It's really to protect and preserve what you've built. It's a bonus if you can grow and accumulate wealth. And if you stay inside of an investment portfolio or a stock portfolio in your traditional retirement accounts, you should be shifting into things that are more conservative, which means your growth is going to go down the closer you get or once you're in retirement. these accounts don't have to worry about doing that shift because they have a 0% floor, so there's no chance of loss anyways. Now, obviously, a strategy like this takes some serious planning. You want to make sure that if this is something that you are interested in doing, that you connect with a licensed life and health agent where you live that can navigate you through how to do this. Because this is not something that just every insurance agent and most financial advisors will know how to do or recommend to you. If you'd like to work with me or my team, we do strategies like this all the time. And we do work hand in hand with CPAs to make sure that we're also making proper recommendations based on clients' tax provisions. You're welcome to click the link in my bio, schedule a call with us, and we'll have a complimentary conversation to see if a strategy like this could be a good fit for you. And if you like this video and you want to see more just like it, I release a new video every single week. All you have to do is hit that subscribe button and click the bell to turn on notifications, and you'll get notified when my next video comes out. I love it when you stay till the end. Please share this again with anyone you can think of that can benefit from a strategy like this. And I look forward to seeing you guys back here next week on YouTube.